We've all heard people talk about valuation multiples, but what exactly does that mean? Why are they used? And what are the limitations? Well, without getting too technical, multiples are a way for us to standardize the value of something. For example, when comparing two houses of different sizes, you might standardize the value by looking at price per square foot. You could then apply the price per square foot to your subject property size and get an estimate of its value. Valuation multiples are a way for us to standardize the value of a business for comparison purposes. And we can standardize it a variety of different ways. We could look at price to revenue multiples, price to EBITDA multiples, price to EBIT, price to sellers' discretionary earnings. Or when we look at publicly traded companies, we might look at price to after-tax earnings. There's a direct relationship between the multiple of a business and the rate of return that buyers require on their investment. So if you believe that a company has risk to its income stream, the multiple will be reduced to compensate you for that risk. And if we believe that a business is sound and should remain flat or even increase, then the multiple could increase. There's a couple big limitations when trying to use multiples to estimate the value of your business. First, it's important to make sure that you're applying the correct multiple to the same financial metric. If, for example, you attempt to apply a revenue multiple to EBITDA, you're going to be far off in estimating the value of your company. A second big issue is that different industries will trade at different multiples due to a variety of different reasons. For example, different growth rates or different margin structures. This would be analogous to trying to evaluate homes that are in a different town or a different school district. And of course, we all know that the price per square foot is going to be dramatically different. Even companies within the same industry can trade at a huge range of multiples based upon their size, team, quality of earnings, contracts, and ongoing financial obligations. Of course, understanding multiples is really important, but it's much more of a guide rather than a hard, fast rule. Stay with us for future episodes as we turn our attention towards some of the blocking and tackling that you can do to increase your multiple. We'll see you soon.